uh, to institutional order flow. All right. So very first piece, institutional order flow, right? Order flow is the continuous pricing or repricing, sending price higher or lower, right? It's that consistency of price respect and premium arrays or discount arrays and so on and so forth, right? As a trader, we don't need a footprint chart or indicators to track order flow because it's shown within the consistency of candles and PD arrays, all right? So when we're speaking about order flow, it's literally as simple as there's a sell side of a curve and then a buy side of a curve. All right, just like we see here, right? Sell side of a curve and a buy side of a curve. Now, what's important about that sell side or that buy side of a curve? All right. So the key point is that when we're speaking about the sell side of a curve, all right, this is where up close candles, right, will support price. When we're speaking about buy side of a curve, right, this is where down close candles will support price. All right, and this is very important. This has nothing to do with time frame. All right, as long as you have a range, an array, right, and prices is always moving, right? Of course, there will be the need for a buy and sell program, right? And you'll see that because of that accumulation, manipulation, distribution, accumulation, manipulation, distribution. All right. So buy side of a curve, once again, keynote, right? Down close candle will support price. And then what you'll see on that buy side, while those down close candles are supporting price, the premium arrays and the up close candles, because obviously this is always going to be an up close candle here, so on and so forth. The up close candles are violated, right? The down close candles are supporting, all right? The discount arrays are respected, right? The discount arrays, every time price is pushing back here, that's a high resistant liquidity run, all right? The stops here are for the most part protected because price is trying to reach higher. All right. So these are going to be high resistant liquidity runs. All right. Now, the premium arrays, these guys, right, this stuff is going to be low resistant liquidity runs, right? You're going to see price have a much easier time running out those premium arrays when you're on the buy side of a curve. All right. On the sell side, just the opposite, right? Of course, the up close candles are supporting, down close candles are violated. All right. So when we get to the market maker model piece, you guys will see whatever was on the left side, whatever that behavior was up at least into the array, right? Something changes. All right. And then we start saying, okay, cool. I'm on the sell side of a curve or I'm on the buy side of a curve. All right. But when we're on that sell side, once again, down close candles are violated. Premium arrays will be respected, right? The high resistant liquidity runs will be above market price. And the low resistant liquidity runs will be here, okay? Because now price is met some point of valuation, some type of array, some significant level, and now that order flow changes, which is where we get our smart money reversal from. We'll go into more greater detail about that. All right. So just to give you guys a few like chart examples of this, right? And when you're looking at price, and every time you're looking at price, and you see price go from here, point A to point B, right? And then point B to point C, you should literally be taking that chart and splitting that chart in two. It doesn't matter what time frame, right? If you get into a habit of doing this, what you will see is that, like I mentioned, you don't need a footprint chart or any type of indicator to track order flow. Like I know you guys have probably seen those future traders use the footprint charts, and it shows the amount of orders that are coming in at each time. All that is price reaccumulating and then pushing this way, right? Reaccumulating, right? And those orders are coming in. the chart itself will show you that. It will show you that within the consistency of down close candle supporting price or up close candle supporting price. So every time we look at price, if we zoom out here, let's actually even come to a weekly chart. All right. If you were to just look at price action right here, okay, right? Obviously, of course, we're on the sell side of a curve. All right, but before we got to that sell side of a curve, there had to be a buy side. Okay. So let's change the color of this. All right. Now, on the buy side, there's more of a consistency in these down close candles supporting the direction of price. All right. At least until we make it to some type of higher time frame PD array. All right. So right here, if this is a weekly chart, price had to have pushed into a monthly or quarterly array. All right. Once we make it into that array, now you start to see a change. All right. Because over here, we saw discount arrays being respected, right? Price trading into discounted fair value gaps. Those guys are being respected. We're trading into mitigation blocks, right? So on and so forth. Once we make it up into the array, now what we start seeing is up close candles, right? Or premium arrays. These guys start supporting the direction of price, okay? And then what you'll see is over here, price is no longer honoring those down close candles, right? We're seeing down close candles are now becoming the low resistant liquidity runs, right? And price is more protective of the buy stops, right? Or at least for each parent price swing. Okay, so right here, we're constantly seeing these up close candles. These guys are supporting price. All right, price has a much harder time running through these up close candles. Every time you look at a down close candle, now that you're on the sell side of a curve, your thought process should be low resistant liquidity run, right? Because price has a much lower level of liquidity that it's now seeking for, all right? Because we've had our, power of three, which we'll speak about in a second. All right. Now, what we have to understand is when we're looking at this here, all right, we're looking at an image and we're zoomed out. However, think about the price action right in here, right? As price is going, stops to inefficiency. Okay, think about the order flow from this low to this high, right? If you think about price action as it's moving from this low, obviously, if we were to take this range, all right, if we were to say, hey, because every time we look at price, we need to understand the overall range that we're in, all right? We take that range, okay, this is that range. And once we have the range defined and we understand that buy and sell programs will form within defined ranges, that's a key point, all right? You find the range, you find the array, right? Because the array provides potential, right? Price is going to seek that array, right? In this case, we have fair value gap, okay? So that means that the only way price makes it to this array, right? It doesn't just teleport there. It doesn't just happen there from randomness. No, there's going to be a consistency. What is that consistency? That consistency is on its way up, right? If it's going up, we're going to see a consistency of down close candles and discount arrays supporting price, right? Whatever up close candles were within this leg down, those guys are gonna start becoming violated. All right. And price is going to respect those discount arrays up into it reaches its higher time frame level. All right, or it's going to respect those down close candles. All right. Once it meets that higher time frame level, then you'll see, man, price is no longer respecting those down close candles. It's no longer respecting discounted fair value gaps. All right. So if we take this little piece of price, and then we'll go inside of here and we'll see what we can pull out. Right. So right here. Right. And you guys can see this is the market maker model. So what I was mentioning, market maker models will form within defined ranges. All right. But what's most important for where we are now within this lecture is simply just looking at the order flow. All right. So as price is on its way up, right, it should jump out at you what that current state of order flow is. We start seeing these down close candles support price. All right. These guys become more so low resistant liquidity runs. So when you're looking at price, every time you start to see, right, we see price move here, right? Maybe these are buy stops in the lower time frame, but then we push back down into inefficiency. We go inefficiency to stops. Well, guess what? We go from stops back down into what? Inefficiency, right? Discount arrays, discounted fair value gaps are being respected. Every time price has to go from stops to inefficiency, inefficiency to stops, technically what that's creating is a market maker model. All right. So what happens is you get market maker models within market maker models. All right. This is a market maker buy program. This is a market maker buy program. However, they are just smaller phases of reaccumulation in reference to the larger buy and sell program. All right. And once again, we're going to go into greater detail in terms of the actual buy and sell program. I just want you guys to basically build a keen sense of order flow. Okay. Right here, this is a key point right here. Yes, a down close candle was taken out, but there's a key point, right? Because there's a way we decipher between if it's a run on stops or if it's actually a shift in order flow. All right. And the answer to that is what happens here. Okay, and we're gonna touch on that later on. All right. But anyways, down close candle support and price, we make it up to that array, all right, or to some key level. And what you guys see is there's a change, right? Down close candles start taking the day off. Up close candles begin showing up for work. All right. And then there we go. Right. Off to the races. And then we should see more of a consistency of that because, this overall market at this point is bearish, right? You guys can see here. Right. These up close candles supporting the direction of price. All right. This idea or this concept, right, is very fractal. You could have a 15-minute range looking at a 1-minute chart. On that 1-minute chart, as price is moving up to that array, you're going to see down close candles supporting price, down close candles supporting price, right? Once it gets into the array, something changes, all right, which is that order flow and that consistency of discount and premium arrays. And then we start to see, and we can say, hey, I'm on the sell side of a curve. So why is this important? It's important because you should never put on risk. I should never go short if I have to look at a chart and say down close candles are supporting price. That means I'm forcing my will on price. So if I'm going short in a market that looks like this, right? Down close candle, down close candle, down close candle, down close candle. These guys are supporting price. These down close candles have shown to be the high resistant liquidity run, right? Why would I short when I can't say, hey, we're now on the sell side of a curve? Right? It's low probability. So a lot of times when you're taking that blind entry at that fair value gap, once again, and you haven't confirmed that current state, right? Not what you think order flow is going to shift into, but it's that current state of order flow starting from a lower time frame because you don't reach higher time frame until you get to lower time frame. I always draw this little image, right? I don't get to the 4-hour, right, or to characteristics on a 4-hour chart without first getting or starting from that 1 minute or 2 minute or 5 minute, 15, so on and so forth. All right. So that's order flow. Okay. So we have buy side of a curve, sell side of a curve. All right. Go back here. All right. Now, power of three. All right, because this is important before we get into market maker models. All right. So power of three, as we all know it, is basically accumulation, manipulation, and then we have our distribution. All right. So the power of three, of course, is a concept taught by ICT that relates to the daily open, high, low, and close bar on the daily chart. All right. Now, of course, this is not just subject to a daily chart. All right, but this helps traders capture the bulk of the range by buying near the opening price on an update and exiting on the close. When you're bullish, you want to be buying near or below the opening price, which allows the range to expand. Right, that's that distribution for us, and then we get a higher close. All right, the concept aims to help traders understand the accumulation, manipulation, and distribution phase of a daily range, but we can just say any range, right? Because that concept is fractal. Okay, so power of three, right? Now, when I think about power of three, the most important part of that is because that is what explains a candle. All right. That is what explains an up close candle. That is what explains a down close candle, right? Obviously, we know a down close candle is open, high, low, close. All right. And then on the flip side of that, we understand that the up close candle is open, low, high, close. All right. Now, what's important about that open, high, low, close, open, low, high, close? When I'm looking at this down close candle and I think open to high, right? This is price, right? There may be some defined range from here down to here, right? So from open to high, when I hear that, what I'm thinking is price moving from discount to a premium array, higher time frame premium array, right? Open to high, we're moving to this array, right? Which is where the manipulation is coming from. So the open, this is our accumulation. The manipulation is prices move up to that key level, which happens to be the array. All right. What I also hear when I say that is I hear buy side of a curve, right? Which means if price is literally going to go from the open to the high, as the trader, I should see down close candles supporting price, right? I should see a consistency of these down close candles supporting price, right? Maybe it's early in the week, maybe I want it, or early in the month, the year, doesn't matter what time frame, but maybe I understand that because this is a new month, right? Price is going to trade above the monthly opening price there's an array above the monthly open, right? I can be buying, right? But I'm only going to be buying behind the premise that down close candles are supporting price, right? Because we're running up into that premium array. All right. Now, once price reaches into that array, right? And obviously, you're going to get your market structure, right? You're going to get that delivery that we now understand to be a high probability pricing sequence. Once price reaches up into that array, right? We're now expecting to get that distribution phase, right? That part of the power of three. So we got the open, which is accumulation, right? The high, right? Manipulation, right? And now to create the range, that's that all of this would be that distribution phase. All right. So next week when we talk about weekly range expansion and all that stuff, this is kind of a tip off for that. All right. But now we have the range, right? This is where we expect the price to distribute, right? Those guys have ran price higher. They've accumulated short positions along the way, right? And now it's time to offload those positions. All right. So now price doesn't just run from high to low, right? There's something that's going to happen. Okay, these down close candles that were on this side of the chart, right, that we were seeing support price, these guys are now going to become the low resistant liquidity run, right? Hence the breaker that we talked about last week. All right, so there's going to be that up close up here. And you're going to consistently see every time price trades into an up close candle, it forces a new change in state of delivery. Right. And then we can say, confidently say, oh, yeah, we're on the sell side of a curve now. right? Because price is more so respecting these up close candles, right? And that price action will continue and carry over until we create the entire range here, right? And as it's repricing lower and lower and lower and lower, right? This could be a whole monthly candle, but as it's repricing lower and lower, as you notice, price is trading from stops to inefficiency, stops to inefficiency. So what do you think this is? This is a market maker model. Here, price is going here to here, even up here to here, right? You know, if you scale down and lower on certain time frames, you'll see the more defined characteristics and every intricate piece of how that model is being created. All right, but just understand the basis of a market maker model is really power of three, right? Because it's price pushing high. A market maker model is nothing but price pushing higher to go lower, right? It's a hedge program, or pushing lower to go higher. Okay, that's why once we start looking at commitment of traders, you know, you'll see if you're expecting price to go lower for a long term, you'll see those guys, you'll see that commitment of traders go higher first. But the market will be going lower. Why? Because it's a hedge program. They aren't selling when you think there should be a ton of selling, or when that commitment of traders scale is showing that they're net short or net long. All right. Now, so let's move into the actual market maker piece, right? The buy and sell program. Okay. The market maker model refers to the process of understanding how market makers operate in the financial markets, right? So in the context of ICT, the market maker buy model is when the market drops down and has a price swing lower, reaching into a higher time frame or intermediate term support level. All right. The idea is to anticipate the market move lower and watch it go lower, potentially taking short positions. No different. So what that's saying is no different than here, right? If we were expecting price to go lower, right, we will watch it go higher first and potentially take those buy positions. Why? Because we understand where the array is, and we understand that array should be the catalyst or the turning point for price action. So that's in comparison, that's what this part is saying. All right. Market makers scale in early, buying at different levels because their positions are much larger than retail traders, right? So what that means is as those guys are pushing up, all right, and this is just understanding the logic behind price action. As these guys are pushing up, right, that stops to imbalance, that repricing, that rebalancing. All right. What's happening is every time here, right, these guys are hedging into the market, right? So they already understand that this is a key level. You want to offload positions at that key level. Before they reach that key level, right, they're not just going to put on 100 million positions at that one level. They're going to scale in as price is going higher. So every time you see price coming back lower, right, these are these guys tacking on those positions. Okay. So a keynote, something that you guys have probably already seen, is every market maker fractal makes one component of a much larger model, right? Each model will have an open high low close or open low high close dynamic too. Okay, we'll come back to this image. And also on the other hand, right, the sell model, right, is the reverse process. All right, so this is where these guys will hedge into the rally, right, just going up. They'll hedge into the rally, selling short, just like we see on the buy side or the sell side. All right, there are market maker buy models within sell models and market maker sell models within buy models. This is a key point. All right, it's a matter of understanding narrative and knowing the higher time frame draw. All right, so what I mean by saying there are market maker buy models within sell models, this could be a sell model here, all right? But prices, let's say price is pushing higher, it might have taken out a buy side liquidity pool to the left, right? This might have been buy side liquidity. Okay, what's going to happen is there's going to be an array down below market price. Price is going to want to make its way to that array. Right? That becomes a small buy program within the entire sell program. All right. So you may be on a lower time frame and you may be seeing a buy program. You may understand that this is the sell side of a curve and you're just waiting for price to get to that array. And then the next step is seeing if institutional order flow changes over. Once you can confirm that, then you can expose your portfolio with a lot more confidence. All right, within your trading. All right, this is an example of these guys pushing price lower. Okay, as it's going lower, you can see the buying is taking place. Makes it down into the array. And the same thing happens once we make it to the buy side, right? They're hedging into the market. They're selling into the market because at some point they're going to offload those positions, right? And that's when we see those heavy expansions, right? So let's do a little, we'll do a little example here. And then one other key point, right? How to spot the market maker model, right? Just think about this here. Think about the fact that price trades from premium to discount or discount to premium, from stops to imbalance or imbalance to stops, from internal range liquidity to external range liquidity and back to internal, right? When you're saying that, basically what you're saying is there's a market maker. Saying all of this is just saying power of three. It's saying accumulation, manipulation, distribution, right? From premium to discount, accumulation, premium, discount, manipulation, back to premium, right? That process is the distribution. That becomes a market maker buy program. You just have to put the pieces together in between. We're gonna do a little walkthrough of that. All right. So once again, buy and sell programs will form in defined ranges. So let's take what we've learned in terms of order flow and structure and all that stuff, and let's put it into this little example. Okay. So let's imagine that we have this type of price action here. Right. All right. So we have this. This is the current price action, and I'm gonna draw a. Obviously, there's going to be an array above market price. Trying to get my line straight. So this is our array. Okay. And before we focus on the, what's going to be over here to the left, let's just dive into this current price action. Okay. So let's say price gets here. Obviously, based on what we've learned, this would be that short-term low that's created. All right. Price trades from stops. And obviously, there would be some type of inefficiency in here. And if price is bearish, we'd continue to expect it to trade into this inefficiency, right? And then go lower. Okay. But for some reason, there may be a higher time frame array to the left. There's something or something that's serving as that turning point, that official turning point for price. All right. So now at this point, all we have is a high and a low, right? We saw price take out stops. Now we're anticipating trade to imbalance and then balance back to stops. For some reason, price gets up here to this inefficiency, and then we close to that inefficiency, and then we see price exit the opposite end of that range. At this point, we're thinking, bullish dealing range, right? We're also thinking because we've just gotten this intermediate term low, right? And following that, we started disrespecting the higher time frame premium arrays up here. Now we have our bullish dealing range. Our thought process is price is going to create the other short-term low. All right. So if I'm saying that price is going to create the other short-term low, that means as the trader, I'm looking at this current range of price. All right. I'm studying this range. I'm going through my PD array matrix. Obviously, if this, this would be a breaker up here. All right. Over here, we might have a fair value gap. Let's say we have the FVG, right around here somewhere, right? We're anticipating that short-term low to form. All right. Because order flow, right? Once it got up here to this array, it never changed. All right. So order flow is here. We were seeing down close candle, down close candle, down close candle, right? When it got up here, we were looking to see if down close candle, if these guys were going to start being violated. We were looking to see if the lower time frame buy side inefficiencies were going to be violated. Price got up here and that never happened. It carried through. All right. So now as it's repricing back lower, we're looking at our arrays and we see this inefficiency, and we should be thinking in our mind, right? We should be thinking, I'm going to see a market maker buy program form, right? As price goes down to that array, turns around, I'm going to see a market maker buy program form. All right. So that order flow, that's bullish here, where down closes supporting price. All right. We're going to make it through these stops. Price is going to go stops to imbalance. The way that we know it's ready to reprice back lower to the inefficiency is when I start to see up close candles start showing up for work. Right? These guys are supporting price. Those down close candles on the left side, right? Those guys are getting violated. Price makes it into the array. All right. Think about this also, right? This is that efficiently traded price range, right? Not drawn to scale, right? However, that's just at this point we should all be able to kind of imagine this. But this is that efficiently traded price range, right? Price is coming back to that fair market value point. All right. It's also accompanied with a few other arrays, right? We have overlapping arrays. Okay. It makes it down into this area. And then something changes. Now we start seeing the down close candles support the direction of price. Right. So down close candles, once again, these guys are supporting the direction of price. We take out stops here. And then price is going to want to reprice back to whatever inefficiency or whatever array that there is within this range. So you have a buy program that forms here. From this point here, you have a sell program. All right. Now, not a lot of you at this point have probably wondered or heard, well, the buy and sell program needs to come back to the original consolidation, right? Or needs to run through the original consolidation. That what determines that is the current overall buy or sell program, or the overall framework, right? In this case, we're trying to meet this higher time frame array up here. So I'm not really anticipating for price to need to run back to if there was the original consolidation here. Maybe it just runs down to the very first phase of reaccumulation, which we'll cover that. We're going to go into it. All right. So here we are. Once again, we're going back down, sell side of a curve, down into the array. All right. I know this part is getting repetitive, but I have to go through this so you guys can really catch on to this. All right. Then we go back. Something changes, down close candles start supporting price. The up close candles, these guys are being violated. Okay. And then price is ultimately running itself up into this array. Now, Key point. We were looking at that price action on that time frame. All right. But something that's key is zooming out. There's a much larger time frame where we're seeing these up close candles support price. So we're basically as the trader, we would understand that retracement, right? It should retrace only to the extent of whatever that higher time frame point of institutional order flow is. All right. So if that up close candle, right, we see price come down, go up, right? Up close candles created, down. All right, this is where we got our fair value gap from. Right, and this is that array we scan all the way across market price. Okay, so it's making its way up into that up close candle, which is a part of a higher time frame sell side of a curve. Right, here we are. So once we zoom out, we really understand where we are in terms of market price. All right, we're just on the sell side. This is a sell model, right, which is on the sell side of a much larger market maker program. That much larger program may look just like this. All right. We're probably at this little part down here, creating this little pullback. Okay. So let's zoom back into here. All right. Now, what you should be noticing here is this is that market structure, right? This is that short-term high being created just below the array, right? It's crouching. It's engineering liquidity. So as a trader, we're understanding this process. We're understanding what's going on. We're understanding the entire framework and narrative that's being created and laid out in front of us by IPDA right now, by the algorithm. All right, nothing's happening just to happen. It's happening in a very detailed sequence. Okay, so we have the short-term high. We run up into the array. All right, now this is a key point because we're like, oh shit, this is the point at which we run into that much higher time frame institutional order flow, and we're really expecting a true turnaround in price. All right. Now, before I go through that point, what you guys have to understand is right here, that delivery creates a down close candle. Okay. This delivery creates a down close candle. This delivery here creates a down close candle. All right. So you started seeing intermediate term time frame down close candle support and price. To what extent? To the extent of the higher time frame array. All right. Because going back to those laws of physics or motion or whatever, right? An object is going to move in a certain direction until met with a much higher, stronger force. That higher, stronger force is this higher time frame array here. All right. The more macro time frame. Okay. So we get up here. Now, as a trader, you're saying, all right, I'm expecting a true turnaround in price. All right. Price should turn around. Now, actually, let me draw this to perfection so I don't confuse you guys. So let's imagine that this down close candle is at the bottom of this range. All right. So this is that down close candle. Okay. So you're saying, all right, well, shit, from the intermediate standpoint, price has been respecting these down close candles. Like I see all the lower time frame buy and sell programs, and here we took advantage of it. We understood where we were at every single point within the market. All right. However, we've just made it to that much higher time frame array. Okay. So now we may be able to gauge the turnaround at least to the extent of where? this down close candle. Why? Because these guys are supporting price right now. Now I know we've made it to the much higher time frame level. However, to truly confirm a real turnaround in price, right, to where we can set ourselves up for much longer term trading to really understand what's going on, we'd want to see price violate this discount array. All right. So here we are. We're seeing these up close candles support the direction of price. Premium arrays are supporting the direction of price. Discount arrays are being violated. All right. Price reaches down here. This here was a sell program. All this was a sell program. All right. This right here was a buy program that turned into a sell program. All right. So now we just got down here and you're looking at price and you're like, oh man, we literally just took out that down close candle, right? We created that intermediate term high. We just ran through this level. All right. We come through this level and we actually get body closures, fair value gaps through that level and everything. All right. It's starting to look good. All right. But let me make one key point. Okay. When we're looking at price, all right, and when I'm saying, hey, on the buy side of a curve or the sell side of a curve, up close candles should support price or down close candles should support price, right? We have to understand that there's going to be times where a down close candle gets violated, right? A down close candle was violated. How do I know if that is just a stop run or if it's an actual change in this institutional order flow? Easy. The candle up here, right, that led to price violating this area, okay? If that candle doesn't force a new change in the state of delivery, meaning it doesn't force it because this is going to be an up close candle trading into it. If that doesn't force this second change in state of delivery, that means that this move was just a stop run. Because if price goes up here and it doesn't slow down, it starts violating imbalances within this range, that was just a stop run. All right. And then also you guys understand now in terms of how price actually leaves ranges. We saw last week, EU kind of had this scenario on EU. It didn't really, we started creating rejection blocks at a particular level. And then what did we see on Thursday, Friday? It literally ran right back through all of Wednesday's price action. All right. So as we're up here, we've run through that down close candle, right? As the trader, we're looking at how price actually exits that area for one, and then we're looking at the next response. Okay, so now that doesn't mean we have to wait this entire time, right? It's just going to depend on time frame and all that stuff. However, when we're looking at this, we're going to be looking at this current range, and we're going to be saying, all right, this current range is the most important thing in price to me right now. All right, I'm looking at that range, going through my PD array matrix. I'm finding the arrays. All right. So let's say we have an inefficiency up here. Now we're going to see down close candles support price. All right. Obviously, this delivery is going to create what? An up close candle. I see price trading to that up close candle. It's accompanied with a premium array, fair value gap. All right. And I'm looking because I'm expecting this to be a lower time frame market maker sell program, right? You can see the original consolidation. I'm expecting smart money reversal up here. All right. Well, how am I going to confirm a smart money reversal? What is a smart money reversal? Right? That's literally at the point at which you see order flow change over. Boom, smart money reversal confirmed. If you never see order flow change over, there is no smart money reversal. Right? Because these are going to be your down close candles. Right? We make it up into the array. Now, what used to be high resistant liquidity runs, that changes over to low resistance. Okay, price starts running those levels out. Now it becomes protective of buy stops, right? Every time price trades higher, high resistant liquidity run, right? It's probably going to stay within that range. All right. Now, going back to order flow, remember, we ran through this level. For me to confirm if this is an actual stop run or a true change in order flow, I need to see price push up into, right, an up close candle within that parent price swing. And I need to see if that guy is going to force a second change in the state of delivery. Now, think about this delivery. This delivery is going to create an up close candle. All right. We learned the change in state is price trading through that level. So at this moment, when price trades through here, at the very moment, all right, we just saw this candle here force a new change in state of delivery. What that's telling me is that, oh shit, now up close candles are supporting price. Now intermediate term time frame, right? Lower time frame and the larger time frame order flow are all in sync. This, right, was that first phase of redistribution for that market maker model, right? And we haven't even went through each little phase. I'm giving you guys the overall framework of the market maker model, right, as it relates to order flow. Okay, so we come here, we trade down through this level. Now my expectation becomes a lot more refined. Why? Because these up close candles, these guys should be like, this is true support and resistance at this point. Where are we headed? Price over here was going stops to inefficiency, stops, inefficiency, stops, inefficiency. But it's no different. This delivery becomes, so all this delivery here is equivalent to these candles, right? So let's just imagine that's just the next up close candle that's been created. What are we expecting? We're expecting price to trade literally through that point, all right? Because up close candles are supporting the direction of price. Okay, so as a trader, we understand that from a larger perspective, we understand the overall viewpoint of price right now. And we're just anticipating price continuously trading stops in efficiency, right? Here, we might go up through into an inefficient. Maybe we come to that fair valuation point, down close candle supporting price. All right. We turn around, so on and so forth. But guess what the draw of liquidity is? The draw is way down here, right? We understand that. This is the draw. All right, there was some original consolidation that formed down here. That's where prices reprice it back to, right? Right here, you should see your dealing range. All right, no, it's getting messy, but just see through this, right? That's your one. This is your two. This is price rebalancing the range. This is that redistribution, all right? This is your other short-term high that was created. Now you have a swing high. You have a swing high created off of a higher time frame PD array in a market that's bearish. How do I know it's bearish? Because order flow is bearish in the higher time frame. Right? So all pieces are aligned at this point. Okay. So once again, the draw is here. All right. We're anticipating that price reaches that point. Okay. Now that we have the framework for a market maker model, let's get into the smaller detail. All right. More intricate pieces so that we understand those very small, fine pieces. So let's imagine we have this scenario. All right. We have up here, we have an array, right? That array is right at fair value. Okay. Now, when it comes to a market maker model, there's three main points. Okay. These three main points will literally aid you in understanding the entire market. The very first point is the current market price. All right. The second point is the array. Third point is the terminus. All right. So I'll draw those out. We have this range. I'm looking at this range. All right. I'm saying here's my array. Here's my current market price. I'll start to notice, right? Price starts to, go into a little smaller consolidation. But that current market price is where you get your original consolidation. All right. If you guys haven't noticed yet, what happens in consolidations? That order flow that we saw over here, right? At some point when price reaches a certain level, that order flow doesn't really hold up. We start seeing this shit will move back and forth, right? It gets very frustrating. All right. That's what happened. That's what a consolidation is. A consolidation is basically an inconsistency in order flow, right? Price is very indecisive. Right? Something's probably about to change for at least a short period of time. Okay, so we see that happening here. All right, now we leave that range. Think about what we learned about efficiently traded price range. Right, we leave that range. Okay, price has kind of chosen its fate here. All right, we leave that range to where? To the array. Why is the array important? Because the array is where I expect the smart money reversal. Right, so price makes his way here. Boom. All right, so we have, let me just outline these. Original consolidation. And then we have the array. Okay. Now, obviously, I'm drawing these linear. We're going to add the pieces in between. But price runs to the array. This is where I'm expecting a smart money reversal. What is super important up here? Right? What is one thing that we learned from lecture 2 in terms of like up here? Like what's my thought process up here? Right? How do I simplify this? And the answer to that is there's only ever 2 signatures in price. All right. When you're thinking about a market maker model, in your mind, you should see this. And then at the top, either failure swing or breaker. That's all you're ever gonna get. You're not gonna. There's no other signature in price. Those are the only 2 signatures you're ever gonna get. There is nothing else that exists. So you can refine your focus to looking for one of 2 of those signatures in price. All right. So we get up here, and then once that order flow changes, right? Smart money reversal. Now we expect price to trade down to the terminus. Okay, that terminus is the offset distribution. All right, this is where short positions here offset once price takes out this low resistance signature. All right, power of 3, accumulation, manipulation, distribution. All right, so now obviously price isn't just going to run from point A to point B to point C. It's not just going to do that in a linear fashion. Why? Because we learned that these guys have to hedge into the market. All right. So if we're looking here, as that market is going higher, they're shorting. They go short, they go short, they go short, they go short, right? What's going to happen is those areas will be reclaimed once we get to the opposite side. I'll show you what that looks like. All right. So every time that market is moving, it's going higher. And those guys are going short here. It's just OTE. Here, it's just OTE. Right? Optimal trade entry. All right. Just giving you guys visuals at this point. Okay. So let's break down the in-between stuff. All right. So when we're looking at this, all right, when price leaves this original consolidation, all right, and we leave that area with speed. This is that efficiently traded price range, and we're saying, hey, this range was efficient. Price left this efficiently traded price range. At most, we should only trade to fair market value, right? But I don't expect price to run back through that level. This is that logic showing up, all right? You see price go here, trading back down, and then boom, goes higher, right? This very first phase is what we call a low risk buy. All right, this becomes our low risk buy. Okay, we trade higher, we take out stops. Price may want to then trade back to an inefficiency. We go higher again. All right, low risk. We have a low risk buy, reaccumulation. All right, low risk buy is nothing but it's an accumulation also. But don't get so caught up into the names. Understand what's actually happening. All right. So look, we have original consolidation. We leave that efficiently traded price range that we learned from lecture 1, right? Now we're creating the other short-term low. What you have to understand is that market was coming here. It had to give you something like this. Then it ran that low out. So now you have a swing low, right? Goes higher, back down to that inefficiency. We're right at fair value here. And we trade higher, right? Higher to what? Higher into that key level or that array. All right. We push into that array. Now I'm expecting smart money reversal. All right. We already know at this point, smart money reversal just means change in institutional order flow. Come off of that high, get a failure swing, displacement. All right. Now there's buy side imbalances within this range. What is price doing? Price is violating those buy side imbalances. What are we seeing? We're seeing now there's a difference, right? Discount arrays are not holding up. Okay. There's also a down close candle here. There's a down close candle here. There's an up close candle here. There's an up close candle here. Now I'm seeing changes in stated delivery from up close candles. Smart money reversal. All right. We violate the inefficiency that was here. All right. We might see price trade up into the sell side imbalance here. We see a little dealing range form, swing high fractal, displacement, boom. We run through this level. Actually, let me draw with a different color. We run through that level. All right. So now we're just taking out stops. We're thinking stops to inefficiency. All right. But let's pause because I want to focus on these parts here at the top. All right. Remember, as the market is trading higher, what's happening from an institutional level? They're hedging into the market, right? Let's say they have 100 million positions, 25 million here, maybe 50 million here, right? And then they offset the other 25 million here. All right. Now what's going to happen is that area where they went short, right? Where you saw a little bit of a splash, right? Or some type of sponsorship from an institutional level. Maybe there was a displacement here or something of that sort, they have interest in shorting from that level. All right. This is where we start cutting through candles. All right. This is where ICT says that his stuff is completely different than supply and demand. All right, because we're cutting through candles, right? This area was traded through multiple times already. All right, supply and demand doesn't do that. Okay, it's because we're understanding what's happening from the institutional level. So this up close candle that led to some type of displacement here, then price traded higher. It shows there was selling interest from that area. What happens with that selling interest? It gets reclaimed or has the potential to be reclaimed. So that entry model that you guys are seeing in that mini series, if you watched it, all right, that's just me taking this concept here, understanding that everything ICT teaches is fractal, right? And we're using that concept, but then I'm just adding a little bit more sauce on it to actually not just take a blind entry from there, but actually look at a change in state of delivery if that area forces a change in state. Okay, and this is not me talking about entries. I'm just giving you guys an example. But anyways, so we trade back up here, right? And now I'm looking at this range. I'm a trader. I'm looking at this range and I'm saying, oh shit, I have this area where there was selling interest. All right. This here is going to be a breaker. Think about that's a down move. We take out that high and run through that level. That's a high resistance signature. All right. We also have, short-term high, intermediate, short-term. This is a failure swing with displacement. This is going to be a mitigation block, right? This area here is mitigation block. So all these things or these overlapping arrays in the market right now, right? And I'm understanding that this area is potentially going to be reclaimed as shorting interest from that area. All right. So in the lower time frame, we're zoomed in and we're looking for that order flow to change over. All right. This becomes a market maker model within a market maker model. That's what you guys are seeing forming here. Right. You're seeing lower time frame sell programs form. All right. This is also a dealing range at this point. We're just completing phase 3 of that dealing range, which happens to be redistribution phase, right? And then we trade down to the original consolidation. Okay, so what you have outside of those, remember those main 3 points, market price, array, terminus, right? In the middle, because of institutional hedging, what you're going to have is low risk buy, reaccumulation, right? Smart money reversal. Over here, low risk sell, I'll just write LRB, LRS. Low risk sell, here, redistribution. All right. And once we make it down through that low resistant point, that becomes the offset distribution, right? Because they're offsetting the longs that were put on, the shorts that were put on here, they're going to offset those levels once they reach that counterparty liquidity point. All right. And depending on the overall market, the overall framework, that will determine if we continue to carry lower or if we turn around, right? And we treat it, or if we treat this as a short-term low and then make that an intermediate term low and turn around. That's going to depend on the overall framework. Okay. But that right there that is the equipped understanding of market maker buy and sell programs and the importance of them and how they actually work. All right. So let's go into this chart and let's look at just a few examples. We'll try to go into all right, cool. All right, so actually I want to show you guys this. All right, let's track the order flow first. All right, just kind of make this whole thing make sense. So let's say we were coming down, right? Price is coming down here, and we're seeing that consistency. All right, we're seeing that order flow. We're seeing consistency. We're seeing up close candle support price, right? It's very clear. Okay, you're seeing the down close candles, low resistant liquidity runs, right? Price is not having a hard time trading through those levels. It is having a hard time trading through these levels, though, right? Low resistant liquidity run. When price is up here and you're trading, basically you can say, I'm trading the low resistant liquidity run, right? Because down close candles are violated, up close candles are supporting price, right? You see here, low resistant liquidity run, right? Now, right here, price makes it to, just to show you guys for reference, a higher time frame array. This is a quarterly inefficiency, okay? That quarterly inefficiency becomes the catalyst for price. Now what happens is we start to see up close candles violated, okay? Obviously, you imagine we actually looked at this area when we did our first lecture, but obviously you'd imagine that starts on the daily first, starts on the 4-hour first, right? You see that trickle effect, okay? So we see the daily chart, right? Down close candles, right? Those guys were support, up those were supporting price. We reach down into here. Now these down close candles, these guys are not being violated, all right? So then that, once again, that blends into the weekly. All right, so here on the weekly chart, price is trading higher. All right, we're seeing discount arrays respected. Premium arrays, this fair value gap would have been a premium at one point in time. We saw price close through that area, right? Literally right here at this point, when we saw price close through here, combining the things you guys learned about order flow and all that stuff at this point, dealing ranges, you'd already know that, all right, price ain't respecting inefficiency, is probably wanting to make an opposing stop run. All right, boom, we trade through that level, fair value gap. Now what we see and what we anticipate is that down close candles will support the direction of price on a weekly chart. Here I go, down close candle. Down close candle. Right? Right here. Down close candle. Okay, so let's look at all of these. So price trades up here. All right. And we traded up here, right? We took out these relatively equal highs, traded into that up close candle here. Okay, so on a lower time frame, if we were at this point, what would we be anticipating? We would be anticipating a buy program to form, right? And what would be the catalyst? I'd be looking at this range. I'd see fair value gap, right? But at most, trades down to this down close candle. Why that down close candle? Because I'm on a weekly chart. Down close candles are supporting the direction of price. All right. So I can go to this daily time frame, and what I'm going to see is I'm going to see that order flow, right? These up close candles support price until we get down into here. Now, back during this time, this is when there was that bank crisis here in the U.S., right? And then price turned, then the euro gets strong. This is what I mean when I say news follows prices. This shit is so rigged. All right, price is the euro is supposed to get back stronger anyway, stronger than the dollar anyway. Why? Because we made it into a down close candle. But for some reason, banks start collapsing during this time. All right, and I'm no expert on that stuff, but it is kind of weird to me that those things happen at certain times when price says it should happen anyway. All right, but we get here, and then you see on a daily time frame, right? That changes over, right? We start to see these up close candles start being violated, right? And then price starts trading back higher. So what you're seeing is higher time frame level, lower time frame order flow into higher time frame level. That order flow changes over, right? It was already expected anyway. Okay. We trade up. This right here, this is that buy program. We trade up. This is going to become a weekly down close candle here. Weekly down close candle. So what are we expecting? We take out stops. We come back inside of the range. This is going to be a buy program. I can come to my lower time frame, and you can see original consolidation. We get here. Boom. All right. This becomes a buy program. Down here, we went into a period of consolidation right here. This was June. All right. And if you're not understanding order flow, understanding that, hey, weekly down close candles are supporting price. If you're not understanding order flow, right, then you wouldn't really understand the consolidation period that takes place here, right? You'd be so caught up on the fact that this is a downward trend, right? But it's only a retracement. Why? Because higher time frame order flow is bullish. All right. So once price gets down here, you start anticipating or looking for a change in order flow, right? You start looking for a violation of up close candles. And then you start looking for down close candles to start showing up for work. All right. Original consolidation up here. Smart money reversal here. Right. And then remember, if we trade through that original consolidation and continue, or if we stop and reverse, that's going to depend on the overall market framework. All right. Trade through that level. Let's look at the market maker model from actually, let's go into here. That should be Monday, Tuesday. Yeah. All right, we'll look at this level here first, and then we'll look at the one from the previous week. All right, so we have this inefficiency, okay, and this is a defined range. Say we have this range. We're going through our PD array matrix. We have that high and that low. And remember, market maker models form within defined ranges. I'm looking at a high and low. I'm seeing inefficiency. Cool. Well, that means that if market is bearish, right, we're violating down closed candles. All right, I should see price trade up to a premium array, turn around. That's going to create a market maker sell program. All right, go down to my 4-hour chart for lower. Okay, and then what we see here, we have an original consolidation. Let me go back. Let me go back and mark out the inefficiency. All right, 30-minute chart, original consolidation, low risk buy, right? Reaccumulations, okay, smart money reversal. Okay. On the lower time frame in here, you'll see the down close candles are violated over here. Up close candles is showing up for work. And you get your phases of redistribution. Okay. And then price trades back down through that level. But we're only looking for this. Why? Because we understand that we're on the sell side of a curve. We're on this side of a curve of a larger time frame. All right. We're resting right here with an inefficiency. Basically, we're just exploiting this price action. Understanding that market should go lower. That's what we just did here. Okay, because we're understanding the overall framework. Okay, 4-hour. Same thing happens here. This is a lower time frame market maker sell program right here. So we have an inefficiency. Right. Now, of course, unorthodox. All right, but same rules apply. Same things apply, right? From here to here to here. All right, and you'll get to a point where you don't need to see the perfect scenario. All right, but let's go to the last few weeks price action, and we'll actually see that perfect or textbook buy or sell program. So we had this right here, this level here. Daily chart. All right. Order flow. Everything starts with order flow. What's support and price? Premium arrays, up close candles. All right, cool. I'm not going to try and trade against that. All right. I'm thinking that that array becomes a catalyst. Okay. Now, this is where I want to speak about hierarchy of arrays. All right. Because obviously, we're seeing this right here. And you might say, all right, we're constantly taking out up close candles. We should be bullish. But what you have to do is understand the hierarchy of arrays, right? Because if I zoom out on the daily, right, price is just reaching for a higher time frame level. So key point, when you know what the overall order flow is, and you have to catch this, if if price violates, let's say we're looking at a 4-hour chart, and if price violates that 4-hour level, which might have been here, all right, that means zoom out to my daily time frame and see if there's an array that might take precedence over that 4-hour level that was resting here, because there might be a daily array. If price starts to take out the daily order flow, or what you've seen consistent in terms of order flow, I need to zoom out to a weekly, because maybe there's a weekly inefficiency resting above that daily candle. All right. Doesn't mean that order flow is completely switched. It's just price is moving to a much higher reference point. All right. So right here, we take out that 4-hour, we take out these 4-hour up close candles. However, we're just trading into a daily array. All right. So if I go to that lower time frame, we're going to see that defined market maker model. All right. This becomes the array. Remember, that's the daily inefficiency. Just so happens to be a buy side liquidity pool. All right. Price gets down here. It leaves behind, purposely leaves behind a low resistance signature. All right. A lot of times what you'll see at these reversal points, those main 3 points, because original consolidations at some point in time, like right here, right? This at one point in time was a smart money reversal, right? But then it turns into original consolidation, right? So the smart money reversal and original consolidation, they just interchange because the market is it's ever moving, right? So this purposely leaves behind that failure swing or that low resistance signature, right? Price is going to revisit that area. We see it leave that range with speed, comes back. We don't expect it to trade all the way back through that range. This becomes that first low risk buy. All right. Travels higher, takes out stops, trades back into the range, reaccumulates here. Then we have that last run to the array, right? So you have market price, array, terminus, right? We make it up to the array. Let's go into here. We make it up to the array, and let's look at a lower time frame to see if we can spot on a lower time frame a change in order flow. Maybe sell side imbalances are being violated. We see efficiently traded price ranges are getting traded through, right? And honestly, that's exactly what we're seeing here. So price makes it up here, and we start to see it start to engineer these buy side liquidity pools, right? ICT talks about those 3 drives into an array. He's saying that because you don't want to see price just run to the array and then think that this is the move that's going to turn price around. A lot of times that move is going to be induced. Okay. What you see here is as price is getting up here, we short-term high here, intermediate short-term. You can also look at it like short-term, intermediate, short-term. Okay. But you see that engineer, neutralize, distribute, rebalance, redistribute. Smart money reversal. All right. Down close candles start getting violated on your 5-minute chart. Buy side imbalances start being violated. All right. That's going to start trickling to the higher time frame. Let's look at a 15-minute chart. 15-minute down close candles violated. Buy side imbalances violated. What's even more important is now that buy side imbalances are violated, catch this, we start creating sell side imbalances. All right? I'm seeing more intention behind selling in this market right now after reaching an array, higher time frame premium array. All right, and buy side liquidity pool. So now I'm asking myself, are up close candles supporting price? Hell yeah. How do I know that? That up close candle forced a new change in state of delivery here. Right? Order flow, bearish. That also overlaps with breaker. Right? Up, down, up, runs that level. What is the breaker accompanied by? Inefficiency. Right? I could look at that high to that low. What is that? Dealing range, 1, 2, 3. Right? Engineer, neutralize, distribute, rebalance, redistribute. Okay, but I'm understanding that sell program. Right? I know where my terminus is. So now I start seeing a consistency in order flow. All right. These guys over here taking out, these guys showing up for work. That trickles into a 30-minute chart. 30-minute buy side imbalances are violated. Right? Sell side imbalances respected. All right. You see how this sell side imbalance here was violated? Guess what? Order flow, right? That up close candle becomes like the last line of defense. All right. The high resistant liquidity run is here at this point in time. Low resistant liquidity run is here, right? Price is protective of those buy stops now, right? We keep seeing up close candles support price. All right, look at this. You might say, hey, bro, you said up close candles should support price on the sell side of a curve. This up close candle was taken out. What's the key point? This is the down close candle that led to taking those levels out. If order flow has changed, that would mean down close candles are supporting new changes in state of delivery. That never happens here. This is just a stop run. This was a Judas swing. They had a lot of guys short right here. Price trades lower, right? Where is it trading lower to? Terminus, low resistance signature. What is this? That's just a short-term high, right? Short-term here, intermediate, short-term. All right, putting the pieces together. Okay, then we trade lower. All right, so this right here becomes your low. Well, actually, this would be what we call like an offset redistribution. All right, but you had a failure swing up here, low risk sale, right? This would be redistribution. You have another redistribution here, and then we're making our way through the terminus. Now, what I'm seeing on a higher time frame, though, when I zoom out, I believe this is just the beginner stages of creating this sell model. Right? Why am I saying that? Because I'm seeing order flow has changed over. Right? We're not respecting down close candles anymore. You see these guys back in the past, these guys were respected. Remember we talked about that. Right here we had that consolidated period here because we were trading into a down close candle. Now we're seeing those guys taken out. All right. So I'm expecting that premium arrays should support price. And I'm expecting that we should see up close candles support price. And taking us all the way back down to the original consolidation here. Right. So that concludes my part of the lecture piece. Now we'll open the floor up to questions, or if you guys have any chart that you might want to take a look at, and let's see if we can define a market maker model. You guys just have it. So the floor is open at this point, guys.
I have a question on BPR and original consolidation.
Okay, sure thing.
So, as part of original consolidation, obviously we are targeting the high or the low depending on the trend direction. Let's just say if we moved up and then we are coming down now, we're obviously targeting the original consolidation bottom as the terminus.
Hmm.
Uh, in What I'm trying to understand is the difference between a BPR range versus an original consolidation. Original consolidation, we would target the low, whereas the BPR, we would just expect to retrace back to the 50%.
No, it's the same thing.
It's the same
Think
thing.
of- It's the same thing. Original consolidation. That's why I say don't get caught up in the term. It it's the same thing because look at what's happening here. Is this range efficient? Is this range balanced?
Yeah, yeah.
Absolutely. Now, so what you're asking is you're saying, well, since it's balanced, I think what you're saying is shouldn't we only expect it to trade here at most, right? Is that what you're saying?
Yeah, so in this reversal scenario, am I expecting just to only hit the BPR 50%, or am I expecting to hit the low?
This is where, so great question. This is where overall framework has to come in place, right? Because what type of market are we in? Bearish or bullish?
Bearish.
Bearish, right?
Yeah.
We just traded up to a higher time frame or discount a higher time frame premium array, right? Which is an imbalance. So we just traded up to that inefficiency on the daily. This is this is the original consolidation that you're seeing on the lower time frame. Now, this market trade stops inefficiencies, right? Inefficiencies back to stops, correct? But this is that imbalance up here. These are the stops. You're in a bearish market. Boom. So if we were in a bullish market, then you might not expect it to trade through the original consolidation. It's just like this. Let me give you a prime example. All right. I had a student that had a question about this. And at this point, it looks like we're probably gonna trade through that level. However, I was calling shorts from here because I'm in a bearish market. But if you look at this right here, this this is an original consolidation for a buy program, right? Smart money reversal. All right. So this is an original consolidation right here. Now, so the question you're asking shows up, right? So what you were thinking, it actually shows up here. Now we don't make it to fair market value. We don't have to. It's just that's the max point that we expect. But what you're seeing is you're basically seeing an instance where that original consolidation is not traded through. Why? Because we're in a market where the overall framework, the overall order flow is bearish. The difference is here, yes, we would expect this area to be traded through. Why? Because price is continuously making, it's seeking lower levels of sell side liquidity. This is the low resistant liquidity run, right? Does that make sense?
Um, so back to the example you had where we didn't hit that BPR 50%. Are we expecting that to be hit as a
No. You're
hit?
not. No. Yeah,
Though.
yeah. You're not expecting. No. You're not expecting it to hit 50%. What we're saying when we're saying that is at most, right? Because that is like a fair valuation point. At most, we're only expecting it to when it leaves that range, I don't want to see it really trade beyond that point. Because if it's chosen its fate and it's showing me bullishness, it shouldn't get back below that point. So you're not anticipating it to hit 50%. You're basically saying 50% is like that's like the last line of defense. Right? So it could come here and then leave. That's perfect. I would rather see that. What I don't want to see is it leave and then come back here because then that's going to start telling me, all right, cool, this is just a false run. We're probably going to go here.
Cool. Got it.
Okay.
Thank you.
Yes, sir. All right. Next question.
Hey Chris, I have a question.
Mm-hmm.
Yeah, I saw there's a diagram posted by Vision, I think, in the delivery, and I don't really understand the diagram. Can you please explain it?
Are you which diagram specifically? Are you speaking about the most recent one?
It's in
Yeah,
the gem
that's a
gem
it's in
delivery.
the channel. The gem, the delivery.
The graded price swings?
Yeah.
Yeah. So save that. We'll save that. Let's save it for next week when we speak about bias. All right. But just since you asked, right? I'm a generous guy. Basically, let's say we have a market maker model. Okay. And we're in the market where price is here. We know price is going to trade to that array, and then it's going to run back to these stops. Okay. When I see order flow change, okay, what I can do, because this is algorithmic, when I see order flow change, what we do is we grade this price swing. Okay. What that means is, since order flow has changed over and I'm believing that this is a high resistance signature, we're not really going to run back through that level. And I know where my terminus is, which is here. I'm going to take my fib and I'm going to grade that price swing from that high to where I expect the draw of liquidity to be. All right. I'm going to take that whole range and I'm going to split it into quarters. Right. 1, 2, 3, 4. Okay. What you'll see when you do this is each quarter there's some type of reaction. All right. The 25, you may start, and I'll go more in depth next week. You might see order blocks, breakers, and things of that sort formed at this level. Right. Now the 50%, which is the more prominent, or the most, not really most significant, but it's where we want to keep track of that 50% point. This is where, when you're seeing price and you're seeing that swing happen, you may see something like this. We come down to this third quarter. Once it gets beyond 50, this is where you anticipate either a consolidation around 50 or a stop run back above and reverse. All right. It's a little more advanced understanding, which we'll go more in depth next week. But once you guys really get good with understanding where the draw is, then you'll start grading price swings, and then you'll start seeing certain things happen at certain levels, and you'll anticipate. You'll look at a price chart, and you'll see a certain price, and you'll say, all right, cool, that level I'm expecting. Watch this. So let's say we were here, and I was expecting the price to run down to this point, and I was grading that price swing. All right. So this stuff right here is not random stuff. This is all algorithmic. This is not random stuff, right? It's all algorithmic. Okay. Now, once we got through this 50% point, so think about it. Last week, what was I telling you guys? I was saying, hey, I'm expecting a stop run, right? I'm thinking open, high, low, close for the week. All right. Now we didn't get that last week. We're starting to see a range here, right? Which intraday price action goes to shit. However, I'm calling that this level should be run because we've gotten through 50%. We reacted here, and I'm expecting a stop run and reversal from that level because I'm grading that price swing. All right, and we'll go into a lot more detail for the coming weeks, but anytime that you have a draw or you have a level that price should run to, you grade that swing, and you grade it before it ever even gets to that level. So before this price action even happened, you would grade that price swing. Like if you were down here and you were expecting price to run here, you grade that swing because you'd understand that there's going to be certain things at each quarter. All right. Then even when you get to the halfway point, you can take this as its own measurement, and then you can see, right, the stop hunts, the major stop hunts happen around that 50%. Right. But if you don't understand that right now, do not be frustrated, because I did not understand that my very first time here, and this is not an official lesson. Next question. Man, you guys have so many questions during the week.
I have a question. Can
Okay.
you hear me?
Sure.
Yeah.
Yes, yes.
So you mentioned that when the price takes out the previous high or low, for instance, on the 4 hour, and if the market is on the sell program, and the price comes and takes out the previous high, which means like a high resistance liquidity run. Then you mentioned that on the daily there could be a kind of imbalance that the price is probably pricing into. So what is the process to understand? Because on the daily, if it goes runs one of its high resistance liquidity signature, then probably it's on the weekly. So how do we understand? What's the process to understand where exactly we're in the market? So we go about from the high time frame, and then figure it out, or yeah, I just want to know, like, if I get in on a particular day, how do I go about understanding this market structure or the higher time frame institutional order flow?
Okay. So it's going to come down to simplify all of it, right?
Exactly, yeah.
It goes back to order flow. It literally, that's it. It goes back to order flow, right? So even now, okay, what I'm seeing is we're starting to see down close candles are being taken out, right? We can all agree, right? Down close, I mean not down close, but up close candles are being taken out. All right, this guy was taken out. Okay, well, what led to that being taken out? This down here. All right. So what we're seeing, what we now coming into net last week, we didn't have the luxury of seeing that yet. Now what we're seeing is this down close candle that was the cause of running this level. This has nothing to do with higher high, higher low stuff. This is just simply looking at order flow. All right. This guy here is forcing multiple new changes in the state of delivery. So we're basically seeing that the down close candles are beginning to basically show up. We're getting a swing low, short term, intermediate, short term. All right, we're getting that swing low. Okay. Price also up here. Right here, right? We close that inefficiency. Right? That could have been an early sign for us. Right here. All right. So are you asking how do we know which direction to be going in at this point? Is that what you're asking? I want to make sure I'm standing up with your question.
Yeah, I'm basically asking till where do we know that this is the actual the draw, and then we're going to continue, or the market is actually reversed or not? So at what point do we know? Because on the daily, if it takes out, then we can say that it's some area on the weekly. So at what point can we actually know that the market is reversed and it's going in another direction?
Yeah. Okay. Perfect. Yeah. So it's just like right here, right? If you have and get rid of all of this. The simple answer is order flow, right? If I have an array down here, right? This is an array. Order flow is going to be bearish, meaning the up close candles are supporting price. All right. For me to know if order flow has changed over, I'm going to start seeing a consistency of up close candles taken out, down close candles being supported. That tells me I'm on the buy side of a curve now. I need to start anticipating higher prices. So right here, what I'm looking at is this. I'm starting to see up close candle support and price. Now I'm not going to jump the gun just yet because this has been a range. Right, there's a lot more that goes into it. But for starters, it's simply when price makes it to a key level, like we do down here, we start looking for a change. Right? You saw up here, these guys are being respected. Now there's something is different. So remember during the lecture, I mentioned just because this guy was taken out, I didn't say last week, hey, we took this guy out. Now we're going to be bullish now. No, I didn't say that. Why didn't I say that? Because remember, it's not just the fact that this is taken out. It's I then have to look at what was responsible for, like, where's the point of order flow responsible for taking that out? It's this down here. So now I want to see if price there's two options. Price could either just go here, run right through that level, or it could get to this point and prove that there's some significance from this point. What does that significance look like? That significance looks like new changes in the state of delivery occurring. All right, because we have to be able to determine if this is only a stop point for a continuation, or is this an actual sign of a change in order flow? And if it's a sign of a change in order flow, you'll see down closed candles will start supporting the price, right? You're noticing these are not holding up. The up closed candles aren't holding up. All right. So we may be in for a short-term retracement. We may have to zoom back out to a monthly chart, right? What may happen is this monthly candle may close. Guess what we're going to get? We're going to get an inefficiency. We'll play from that inefficiency. All right. So if this candle happens to look like this, let's say this candle closes here. Now we have a monthly imbalance. All right. So if we continue to trade up, that means on that daily chart, those down closed candles are supporting price. Now we get that monthly closure. So we're going to be wanting to see at some point those down closed candles get violated, and then price gets back into flow with the up closed candles supporting. Right? Because even on the monthly chart, these guys aren't holding up anymore, which is why I'm anticipating we're drawing to this level. All right. You know, this is also a new quarterly candle, right? We're moving above that candle, right? This could be that manipulation phase of this next quarterly candle. This next quarterly candle could very well close. This is our open, right? We could very well close just like this. All of this price action would just be the wick. So that price action where you're seeing that wick, that's that lower time frame, that daily chart that could be showing us down close candle support price until we reach premiums, and then that changes over, right? Everything gets back in sync, and we trade down into that 0-400 level. Okay, so as a trader, as we're sitting here today and we're talking about buy and sell programs and things of that sort, we may be seeing ourselves inside of a potential buy side of the curve of a future sell program. Right? I don't want to jump the gun just yet. We were anticipating, you know, those retracements because we were seeing this, you know, short-term, intermediate, and then price trading back through the range. But I want to see price get out of this first. If we trade through this level, right, then we'll probably see much higher prices. Next question.
Thank you very much.
Mm-hmm.
Hey Chris, I have another question.
Sure.
Yeah, inside the quiz, there's a question that sounds like this. It says that the framework and narrative will override context. So can you give me some example of how this works?
Mm-hmm. Absolutely. So let's say
Thank you.
let's say let's say this first. Basic framework. When we're talking about framework, this is the stuff that we've been focusing on for these very first few weeks, right? This is understanding what side of the curve I'm on, right? This is understanding institutional order flow, all right? The context stuff, the lower time frame context stuff, that's the entry model stuff, okay? So let's say we're in a scenario where, let's say we're in a scenario where the market is traded lower, right? It's trading lower, lower, lower. However, there's a down close candle right here. Higher time frame down close candles, you saw these guys supporting price, right? And you see say you see a fair value gap here, a lower time frame fair value gap above market price, okay? And there's a down close candle right here. And you're only looking at the lower time frame context, but you're not taking into account the higher time frame framework. You're not taking into account that you're on the buy side of a curve. Down close candles are supporting price. All right. So you're prepped and you're seeing that lower time frame entry model form, and you're ready to take shorts, but you're shorting into a down close candle. It's low probability. Then what happens is what you saw as a sell scenario actually turns into that buy scenario. And you're like, damn, why didn't that fair value gap work out? Because this becomes lower probability as price reaches down into those points of institutional order flow, right? So you had context here, but you didn't take into account the overall framework of the market. Another example is, this is one of the more important examples, is let's say we have the market, right? It's trading higher. Let's say we're looking at a 15-minute chart. Okay, it shows up a lot. And looking at a 15-minute chart, then this white is going to resemble lower time frame. Okay. So you may be seeing something on a 1-minute chart, right? And you might see, let's say you're trading 2022 model and you see a structural break on the 1 minute, and you got this little lower time frame fair value gap right here. Right? And you're ready to take an entry right here. You're ready to just go ahead and take that entry. All right. What you're not paying attention to is that you're getting ready to short to a higher time frame discount array, 15-minute fair value gap. What you're not understanding is that beautiful context that you were seeing on a lower time frame. It was only to get price to trade into this 15-minute fair value gap. What do you think is going to take precedent? The 15-minute the 1-minute delivery, or the 15-minute fair value gap? 15-minute fair value gap is going to win that battle. So what happens is you see that, you take that short entry, right? You see a little reaction and then boom, speed. Why did that happen? Because, bro, it was just trading into the 15-minute fair value gap. Right? And this happens a lot. Like, this is one of the more common mistakes for a lot of traders, is not really paying attention to that. So when you're shorting into a higher time frame inefficiency, right, it's literally lower probability right away, because you don't know if price is going to respect that inefficiency and trade higher. All right, does that answer your question?
Yes, thank you very much.
Perfect. All right, any additional questions? None in the chat. Cool. All right. Well, if there are no other questions, guys, we'll conclude the call. I'll make sure I get it uploaded to the chat.
Anything with homework?
Yeah. So for homework, right? And I'm sorry about last week. Last week was a off week for me, right? My son was going through it with being under the weather and things of that sort. So I wasn't as active. But what I want you guys to do, we'll upload the homework to that drive thing. You can do it in the Canva. That's a lot easier. I found that to be a lot easier. All right. What I want you guys to do is I want you to go to a chart, and we're gonna first practice institutional order flow. All right. Way you practice that is simply go to any chart, go to any time frame. All right. And I want you to get 5 bullish examples, 5 bearish examples. All right. And I want you to find turning points on the chart. Turning point, basically price went here to here. You might be looking at it on a 1 hour chart, right? You might be looking at that turning point on a 1 hour. What I want you to do is I want you to create habit of going into that 5 minute, right? And of course, it's going to be relative. Since we're looking at a 1 hour in white, we're going to go to that 5 minute. And I want you to get into a habit of actually seeing what's allowing price to trade up to this point. You're going to see that consistency of 5 minute down close candle support and price. All right. Also, I want you to get very acquainted with what's actually taking place once price reaches into these arrays, because you'll start noticing there is a consistency. It's not just this. It's not 1,000 different things happening here. All right. Algorithm is limited. All right. So once it makes it up there, I want you to start noticing what that change in order flow looks like. All right. This is a very great practice that you guys are going to do. So you're going to get on any time frame. All right. Of course, it's going to be relative. If I'm looking at this daily chart, right? If I'm looking at this daily chart and I'm seeing a turning point, then that means I need to probably go down to my 1 hour to see what that order flow looks like. All right. Like if I'm looking here, then that means for me to actually see what it looks like up here, I probably need to go down into a 4 hour to actually see that order flow change over. Right. Or I can even go into that 1 hour, and then I can start studying and I can start seeing, oh shit, this actually does occur. Right. I actually can see a shift in order flow. All right. So I want you guys to do that. That's order flow. Okay. I'll type this up in the chat. The other part, so we have order flow, that study. The other part is just the market maker models, right? Let's challenge ourselves. Let's find 3 buy programs, 3 sell programs. All right. What you're going to do is you're going to actually outline the range that price created, the array, and you're going to actually outline price trading from here to that array and that turnaround point. And you want to go in and add in those phases. You guys will have there's a resource should be a resource in the chat already, but if not, I'll upload it to where you can remember what each phase is. So what that will look like is this. So let's come right daily. Let's come here. All right, so notice this point. So if I'm looking at a chart, I'm doing my homework. I see price takeout stops, right? We trade here, and I'm looking at point A, array, point B, and then back to terminus, point C, right? You have to believe that on a lower time frame, there's a market maker model. That is a market maker model, right? So what I'm going to do, because I'm seeing those clear and obvious turning points, now I need to study. Now I need to get my eyes acquainted with what is actually happening. All right. What is that consistency that I can train my eyes to see? Let me go back and mark the array out so it's clear. Right here. So we have inefficiency. We took out that low, so we'll call that a break. All right. Now I'm coming down to my 15-minute chart. All right. It's not always going to be pretty. All right. The biggest point is order flow. Okay. I can see over here Up close candles are supporting price. Let's come to a 1 hour chart. Right, up close candles, these guys are supporting price. Right, I'm seeing that low risk sale, redistribution, price makes it into the array. All right, now because this is such a linear movement, you don't really have the luxury of seeing order flow on this time frame violated. However, you're understanding that this is a higher time frame level to begin with. Price should respect that level. All right, this is an area of fair value. Okay, so you might in this case you might have to dive into a very much lower time frame. But you start seeing that change, those changes in behavior. You start seeing these sell side imbalances are no longer respected. Down closed candles right here are supporting price, right? And then price, makes his rally back through that terminus. And then it, obviously it continues higher because the overall market direction in this case is pointing higher. Right. And the whole part about this price action, if you were looking at price in this period of time and you really understood what was happening, and you understood that price was reaching for this point, it's reaching for that imbalance. Right. So institutional order flow, and then we want to go and outline 3 buy programs, 3 sell programs, and just try to include as many of the little intricate details and pieces as you can. And then we'll know what you guys are seeing or what you're missing. All right. If that clears that up and there's no more questions, we'll conclude the call. This week I'll be out. All right. So we'll come back with our next call will be not this Sunday, this upcoming Sunday. It'll be the one after that. Now this upcoming Sunday is my birthday, so I'll be out. But we'll talk about bias. We'll go into bias, and after bias, we get into the entry model, a few other additional pieces of time, and then also that's when we're going to start putting the actual trading plans together. We're going to start talking about how do I trade the New York session, how do I trade the London session, simplifying those approaches, closing that gap of the things I know and your bottom line result, and then everybody will wake up and we'll all be looking for the same consistencies in price. All right. Also, what I'm going to do is I'm going to upload a few examples of the entry model into the chat. All right. It's not to force you guys to go and apply it. It's just to take the things that we've discussed in terms of order flow, change in state of delivery, right, and a high probability pricing sequence. You should be able to take those things. You should probably be able to figure out the entry model without me having to exclusively give it to you. All right, so I'm going to upload those things in the chat. Every single image will look the same. And yeah, we'll just go from there. We'll keep building. So I thank you guys, and I'll see you throughout the week. I'll try to chime in as much as I can, but I will also try to take a break and just kind of enjoy this week for myself. All right, thanks, guys.